College. It's my pleasure to welcome you to today's webinar, Planning for Year-End 2020 and Beyond. As you know, we're committed here at Saint Anselm to keeping our alumni and friends engaged with the college, and in partnership with our centers, institutes, and other departments on campus, and our alumni, we will continue to offer webinars, podcasts, and other opportunities to stay connected. I personally think the variety of programs offered these past 8 months has been extremely impressive, and I hope you agree. This is thanks to many people who have offered their expertise or have suggested a topic. I would encourage each of you listening today to contact the Alumni Relations Office if you have suggestions about future programs, because we will continue these series. Today's webinar is being recorded and it will be posted on the college's website for those who couldn't make it live today. Our panel will speak for about 25 minutes or so, and then we will take questions. There's a Q&A button on your screen at the bottom. Please feel free to submit questions and we'll try to get to them. Now, it's my pleasure to introduce our panelists. Robert Bob Connor has extensive background in family office management, investment supervision, and tax and estate planning. Prior to his retirement, Bob was the executive director of a single family office in New York City. He is now consultant living outside of Charleston, South Carolina. Bob received his BS degree, magna cum laude, from Boston College, holds an MS degree in taxation from Pace University, and is a certified public accountant. Bob served as a trustee of Saint Anselm College from 2001 until 2018, and after a year off the board, he was reelected to the board in June of 2019, and we're extremely grateful for his many years of dedicated service as a trustee. Joseph F. McDonald III, Joe, graduated from Saint Anselm College in 1978 with a BA degree in economics. He earned his JD degree from Suffolk University Law School and his LLM in taxation from Boston University School of Law. He's a member of the New Hampshire and the South Dakota Bar Associations, and he is a fellow of the American College of Trust and Estate Counsel, or ACTEC. Joe is the founding member of McDonald and Kanyuk PLLC, a very strong law firm in Concord, New Hampshire. And he is also founder and director of Concord Trust Company, a state-chartered public non-depository trust company. Joe lives in Bow, New Hampshire, and his son, Ryan, graduated from Saint Anselm College in 2010. Welcome to both of you, Bob and Joe, and thank you for being here today. Bob, perhaps I could ask you to start with a few observations on where the economy stands right now as we approach the end of this amazing year, 2020.
Thank you, Peter. Yeah, it's been a very interesting year to say the least. And I think a lot of us feel that the economy is stronger than we would have thought it would have been in March and April when COVID originally hit. I think the economy is doing pretty well. I think so much depends on the vaccine and how it's rolled out and how effective it is, and when we will start seeing a decline in the number of new COVID cases. I think that will be a real boom for the economy going forward. But right now, considering all of the negative COVID-related issues, I think it's in pretty good shape.
What about employment or unemployment, Bob?
Well, unemployment's still high. You would expect that to be coming down. Labor participation rate still needs to be raised. I think a lot of that depends on COVID. I mean, I think the basic economy has stayed remarkably strong during this time. Unemployment needs to come down, and I think that will be hopefully a function of COVID numbers going down.
Thank you. Joe, how about the legal, the estate planning in general status and status quo as we go into the end of the year and what might be coming in the year to come?
Yeah, thanks, Peter. And I want to thank Bob for his service on the board at St. A's for now 18 years. When I went to St. A's and matriculated in 1974, I was housed in a military-style dorm room on 2nd Street, which is a wing off the administration building, and they stacked us like cordwood in there in bunk beds. And we'd have to go down in the basement somewhere for our meals, which were all steam tables and stuff that you would find at a nursing home. And if we wanted entertainment at St. A's, we'd go to the Stoutenburg gym, which was a bandbox, and watch a basketball game, or down to the JFK in Manchester to watch a hockey game. Later, the West Side Arena, which was a bit of a rat hole. Wasn't much to do on campus, which was great because I was a slacker in high school and I needed all the discipline I could get. And I spent most of my time at the Geisel Library. But my son, when he went, graduating again, as Peter indicated, in 2010, I was shocked at the improvements that were made at the campus. Tremendous. Anytime I toured a campus with my kids who were looking at colleges, I said, look for the cranes in the air, the improvements being made. And it's a testament to the leadership there, Bob, you included as a trustee for 18 years, that you guys have been able to maintain the mission of the college, but still, increase the admission standards. I probably couldn't get in there based on my high school record in 2020. So great work. These small colleges are struggling and they need good leadership. We were talking before we went on here about places like Assumption College or, Merrimack, St. Mike's up in Burlington. They're going to have a tough time. And I think St. A's is well positioned, especially with the help of us as alumni, to continue to build the endowment to prosper and continue to chase the mission and be a great place for people to become adults and form work ethic and preserve their values for adulthood. So that's my plug there. But in terms of the estate planning environment, Peter, when I started practicing law some 40 years ago, there was a finite amount of law that you really had to master to become an estate planner. You need to know trust and estates laws. You need to know the laws of wills. You needed also to know some tax principles, some tax laws. We have an estate tax in this country, which we'll talk about a little later. And back then, in 1982, there was a watershed year for estate tax reform. And, it was pretty easy to be an estate planner back then. In fact, they used to call us red-headed stepchildren, those in large firms who practiced estate planning. The transactional lawyers would bring in the big dough and they'd need estate planners to serve their wealthy clients to draft wills and probate estates. Now it's very different. You got to be part social worker, part economist. You need to know if you're representing people that hold closely held business interests, you need to know how to value them, how to wring them through the wealth transfer tax system in the most tax efficient manner possible. You need to know family law. You need to know the principles of divorce law. Part of what my clients keeps them awake at night is not so much paying taxes. That's always a concern, but they live in mortal fear of some interloper, a dissident spouse, divorcing their kids and ending up with a portion of their inherited wealth as part of a property settlement. So you need to know how you can navigate around the property settlement laws in the various states to protect assets from those sorts of risks. And asset protection in general is important. So it's not just estate tax reduction. Inheritance management is also important. And other things that keeps our clients, particularly our high net worth clients, awake at night is the fear that their kids will become part of the legion of silver spooners out there who clip coupons, receive trust distributions, and become, indifferent members of society, just living off trust distributions as opposed to being all they can be and making it on their own. So trust can be designed to address those issues. Public assistance. Many families have special needs kids who qualify for public assistance. Dropping an inheritance in their lap might disqualify them, and that can be handled through trusts as well. So we got to be the master of many, many trades here. If we're practicing estate planning, we need to know a lot more about different areas of the law to well plan estates. New Hampshire in 2006 adopted very progressive trust legislation. And I, as a New Hampshire lawyer, have been the beneficiary of that. I was telling Peter and Bob before we got on air here that I do a lot of work as local counsel for attorneys from other states, New York and Massachusetts particularly, who are looking at New Hampshire trust laws, the things they don't have under their trust laws that they can take advantage of here. And they're either migrating existing trusts to New Hampshire or creating new trusts that are governed by New Hampshire law for these people. And that is a big source of business for us. So, it's not your father's Oldsmobile here in terms of the trust and estates practice. We'll talk a little bit about wealth transfer taxes, estate and gift taxes, but there's a lot more than just that. And being an expert on trusts and wills than there used to be. So fun area to practice, a lot of ferment, a lot of things going on. And instead of being the redheaded stepchildren, we are now rock stars.
Thank you, Joe. It reminds me of my days as a bank trust officer. We were sort of the stepchildren of the lenders who were making all the money, supposedly, until the market went to hell, the real estate market. Then all of a sudden, the trust officers made the money for the bank to get them through the crisis. Bob, perhaps you could talk a little bit about the investment markets right now, stock valuations, interest rates, returns on investments, and what people might be looking at right now.
Sure. Thank you, Peter. I think the big overhang in the market, and we're going to probably talk more about this as we go on, is the Georgia Senate runoff election, which will happen on January 5th. As I'm sure most people know, that there are 2 seats up, and if they both go Democratic, then the President-elect Biden will have a Democratic House and Senate, and there will be perhaps substantial tax changes coming forward at some point in the future. We just don't know exactly when. I think one of the big impacts on the stock market, if that were to happen, is his proposal to raise the corporate tax rate to 28% from the existing 21%. That will add a significant cost to corporations and will perhaps reduce, some of the stock market valuations. The other side of that coin, again, we go back to COVID and the vaccine. I think the market has rallied here in the last 2 months in anticipation of the vaccine. If the rollout is smooth and we have, significant numbers of people getting the vaccine and the COVID numbers start to go down, that's clearly a big positive for the stock market going forward. Valuations are pretty high. I mean, the market has come back strongly since COVID hit in March. NASDAQ is hitting new highs at the moment. So I think from a valuation purpose, people should be concerned about what's going to happen going forward.
How about interest rates, Bob? People are searching for some return without risk.
And, eventually interest rates have to go up. Certainly with the debt the government is incurring, it will have to go up at some point. It's just not in the foreseeable future. I mean, bonds are just, dead money, and there's really very little in the interest rate environment that's attractive at this point in time. It's a very tough place to make money.
Yeah. And to not lose money.
Not lose money, exactly.
Joe, back to you. Could you talk about any tax law changes that are coming up or that are currently underway that people might want to be aware of in the tax and taxation field?
Yeah, Peter, I mentioned the estate and gift taxes, the so-called wealth transfer taxes. Those are federal taxes. They date back to prior to World War II, when the government was scrounging for revenues to fund the costs of going to war. And they've been with us since then, and they've always tried to exempt from wealth transfer taxes, gift taxes, estate taxes, and there's also something called generation skipping transfer taxes, that if I told you more about that, you'd kill me. But these taxes are not designed to be revenue raisers for the government. Really, the corporate income taxes and the individual income taxes are the pack mules in terms of funding the costs of government. State taxes and gift taxes are really excise taxes paid on the privilege of transferring wealth. And what the policy behind them really is to tax concentrations of wealth owned by families before they're salted away in trusts that can exist outside the wealth transfer tax system and support a single family. If you think back to the origins of our country, it's an egalitarian place, and we threw off the yoke of England colonial rule. They had nobility there, they had landed gentry, they had a permanent upper class, Really what the estate and gift taxes are designed to do is to whack up concentrations of wealth before they get going within a particular family, get them back into the economy, and not have a caste system like they do in, say, India or in the old days, England, feudal England. So designed to whack up concentrations of wealth, aiming really at the 1%ers, the wealthy. And for that reason, the estate and gift taxes have always had an exemption amount that exempts the first X dollars of value of wealth that passes, say, between generations, not within a generation, say, between a husband and wife, but rather between generations, exempt them from the reach of these taxes. And back when I started this, practicing in the early 80s, the exemption was $325,000 per person. So a married couple could work $600,000 plus through the wealth transfer tax system without having to worry about paying a tax, which back then, based on the graduated rate, if you had wealth above the exemption amount, you tripped into the system at a pretty high rate. The maximum rate was 75% back in the old days. So when the wealth transfer tax system kicked in, it kicked in with a vengeance for many very wealthy people. Now the exemption amount, based on legislation that was passed in the first year of the Trump administration, is $11.58 million per person. Peter, think about that. And for a married couple, it's over $23 million for a married couple. And that truly targets the 1%ers, even, less than 1%ers. So many people do not have to worry about wealth transfer taxes based on the law as it exists now. That exemption was part of the Tax Reform Act passed in 2017, as I mentioned. It is scheduled to sunset and go back to a basic level of $5 million per person in 2026. Bob had mentioned the Georgia runoff. If Georgia goes blue, if both of those seats go to the Democrats, then we have Democratic control over Congress. We don't have divided government. In my judgment, if that happens, we've got real prospects of estate tax reform. And what's likely to happen, in my judgment, is not something very draconian, because all the estate and gift tax reforms we've seen over the years have increased exemptions as opposed to reducing them. What I expect to see is maybe a rollback of the existing exemptions back to the $5 million base amount with indexing, probably in the order of $6.4 million per person, maybe as early as the first quarter, second quarter of next year as an effective date. My clients who are exposed are making a mad dash to get gifts made, use up those $11.58 million exemptions before 12/31. As much as I tell them that, there's no chance in my judgment that any estate tax reforms will be retroactive to January 1 of 2021. They don't take that to the bank. They've seen how government works, and they're very cynical and skeptical, and they want to make hay while the sun shines. So we are busy as can be trying to get trust documents done, trusts funded, consuming these exemptions prior to December 31st. So in terms of estate and gift tax reforms, a lot of people speculate that Bernie Sanders, who has run up a bill up the flagpole in Congress the last several years that would reduce to pretty much negligible array of weapons we have to employ for our clients to leverage their exemptions, a lot of the shell games we play with the IRS to use some techniques. His legislation would take dead aim at those and eliminate a lot of those, and also reduce the gift tax exemption to $1 million and the estate tax exemption to some $3 million. I don't think anything like that will ever gain traction, particularly what we see with Biden's putting together his cabinet. I don't think Janet Yellen as Treasury Secretary is going to push for that sort of thing. So even though people worry about a progressive agenda and taxing the 1%ers, I just do not believe that we're going to see anything like that. So there are changes in the wind, to be sure. A lot is riding on the results of the runoff on January 5. We'll have a better idea where the land lays after that. But I'm telling my clients they will still have the opportunity, in my judgment, to still use the $11.58 million exemptions for probably the whole of 2021. the jobs or the Tax Cut and Jobs Act of 2017 that I mentioned earlier was enacted in the first year of the Trump administration, 2017, but wasn't effective. All the tax related reforms were not effective until January 1 of 2018. And I suspect something similar might happen this go around. It takes a long time for tax bills to work their way through the Senate Finance Committee, the House Ways and Means Committee, and then Conference Committee and get signed by the president. So I am not expecting any significant reforms in 2021, no matter what happens in Georgia.
Thank you, Joe. Thank you, Joe. That's very good. Bob, can we go back to the income tax side? We've been talking about death taxes, estate taxes, back to the income tax side of things. Some of our donors here at the college, and certainly some of our listeners today, want to be sure they understand the CARES Act and how that affects us before the end of the year. Is there anything they should be doing or be considering based on the CARES Act, which was passed in the spring?
Sure. I mean, the big things as far as charity goes in the CARES Act is the ability to deduct $300 on your taxes, even if you do not itemize your deduction. So if you take the standard deduction, you can still deduct $300. And that under the current law, that change is permanent. So that will continue for the next few years until somebody else changes it. The other big one, which doesn't affect a lot of people, but is important to some, is that for 2020 alone, there is an unlimited charitable deduction for cash gifts given to public charities. So in all other years, those have been limited to a percentage of adjusted gross income. And it's currently, prior to this year, was 60%. It had been 50% for years and years and years. But for 2020 alone, cash gifts to public charities are unlimited. So if you can literally eliminate your tax liability if you want to give your entire income to charity. Very few people want to do that, but those are important considerations, particularly the $300 for non-itemizers. Bunch of other things just to think about going forward. As Joe mentioned, the likelihood of having a tax bill out that will be effective in 2021, even if, assuming that the Georgia Senate runoff election does go blue, is probably pretty slim. But there are some people that are concerned that that could happen. I think the only thing you can say with certainty about taxes today is that the rates we have in place for 2020 are not going to go down in the next 4 years. And if they go anywhere, they're going to go up. So some people are thinking about accelerating income in 2020 to take advantage of these rates, even though the likelihood of those rates going up in 2021 is still slim. You know, the typical tax planning plan is to basically defer income, because so you don't have to pay taxes on it until the next year, and accelerate the deductions. There's some argument if you had a big capital gain from a transaction that you could either time in 2020 or 2021. I know some people are thinking they're going to take it in 2020, take advantage of the 20% capital gains rate, and not worry about what's going to happen or when or if taxes are going to go up in the future.
Mm-hmm. Bob, what about, and we had a question, consideration of SALT deductions. A lot of people have very different deduction perspectives than they used to for state and local taxes.
Exactly. State and local taxes, and that includes income taxes and real estate taxes, are limited now to $10,000 per year. That was a huge change in 2017 under the Trump administration. President-elect Biden has indicated that he wants that limit raised so that because it does affect more taxpayers living in the higher tax states, which are generally Democratic. So if you have the ability to time those deductions, if your deductions for 2020 are already at the $10,000 level and you can defer any to 2021, that clearly is something you should do. It's likely they'll still be limited to $10,000 in 2021, but it's possible if we could get tax law changes, it could be with effective date. Maybe those deductions will go up in the next year.
Yeah, a lot of moving parts there.
Yep.
Joe, how about retirement planning? Many of our listeners, many of the people I work with here in Plan Giving are 70 and above, and they're either in retirement or getting ready to retire, dealing with IRAs and retirement plan rollovers and so on. What's going on in that area that we might want to be aware of or take advantage of?
Yeah, Peter, as part of that Tax Cuts and Jobs Act in 2017, the Congress eliminated the stretch rules for IRA distributions, which, to me didn't make an awful lot of sense from a policy perspective. The reason why we have tax preferences for retirement savings is to encourage people in this environment where we no longer have big corporations that sponsor defined benefit pension plans for their employees. The feds and the state governments still have those sorts of things, but the private sector generally have gone to the defined contribution route, 401ks and things like that, and encourage people through deductions and tax deferral to save in IRAs and Roth IRAs. The tax policy behind that is to encourage people to, do for themselves what the private sector is no longer really doing for them, and not be a burden on government later, because now they've accumulated significant funds for their retirement to support them in their dotage after they retire. So we all understand why it's good tax policy to encourage savings through deductions and tax deferred growth within these accounts, these IRAs and things and 401ks that people have. But it's entirely another thing to say that to the extent that I have, say, saved in my 401k $5 million, and I die with a balance that is significant, maybe $5 million, and I designate my children to be the beneficiaries of that account, that they would have the ability to take what they call inherited IRAs and roll over their shares of my account and take distributions over their life expectancies. And the way the rules work is that if I've accumulated assets in, say, a 401k, I am required to begin to take distributions on my required beginning date, which is April of the year following which, the year in which I reach now, I believe it's 70 and a half still. And I've got to take distributions over a period measured by my life expectancy plus the joint life expectancy of me and my designated beneficiary. If I have a spouse, then generally it's our joint life expectancy. If she's my beneficiary, we take distributions over that payment period. If I have kids, it's no longer than 10 years greater than my life expectancy. But the way the actuarial tables work and the minimum distribution rules work is that I'm not likely to zero out that account, even if I begin on or around my required beginning date, and I die before the expiration of my actuarial life expectancy. Every birthday I have, my actuarial life expectancy increases based on the mortality tables they use to calculate these things. So in many cases, we have clients who have significant balances that their kids can inherit and then take these inherited IRAs over their life expectancy. So if you've got somebody who has an account balance at the time of their death, their spouse takes what's called a spousal rollover, takes distributions over a longer period than what I was using as the original account owner. And then there's something left at her death, and my kids or her kids end up inheriting those assets and put them in these inherited IRAs. You could theoretically have, through these stretch IRA plans that we used to be able to take advantage of, distributions over a very significant period. And that really is not square with the original policy behind the tax incentives for allowing these things, to allow me to accumulate on a tax favored basis a lot of assets to fund me in my retirement. My kids get a windfall in the form of these inherited IRAs. And if they've got the ability to take it over their life expectancies, well, that doesn't really serve the initial policy purposes for creating these things. So this legislation in 2017 eliminated the stretch IRA. And now basically the rule is that the kids in my example, who each receive these inherited IRAs, have to take distributions over a 10-year period. There are some exceptions to that, but just let's assume that the general rule is a 10-year payout period. It need not be pro rata amounts over that 10-year period. It could be back-end loaded, but that eliminates a lot of the incentive to designate the kids as beneficiaries. And really what it does for my money is it does create an incentive if you've got other assets that your kids can inherit and you figure they've got enough to earmark those assets, retirement assets, tax favored retirement assets, for charity. And what charity is near and dear to our heart as alumni, Peter? What?
Yeah,
Come on, Peter.
college, the mission.
That's right, Saint Anselm College. And the problem with IRAs is that if I own, say, shares of stock that have significantly appreciated at my life, and they pass through my estate to my kids or my spouse at death, my capital gain ledger is washed clean. The new cost basis of the inheritor in those assets is a stepped up basis that's equal to fair market value at the time of my death. That's called the step up basis. So if I have those shares of that stock in a taxable account, then they are eligible for the basis step up. Whereas if those appreciated shares are held in an IRA, a tax deferred account, they're not eligible for the step up in basis. And any distributions received, say by my wife and my kids after my death, for me for that matter, to me for that matter during my life, they're taxed as what's called ordinary income. So the income tax rules relating to distributions from these are not really favorable. And if you eliminate the stretch opportunity, they become even less attractive as assets that can be inherited by heirs. So you can now make, with less trepidation, Saint Anselm your beneficiary of your IRA, your 401k, because the loss of basis step up is irrelevant if those assets go to charity, because the charity can now receive those distributions tax-free because of their tax exempt status. So that's a great incentive, I believe, an increased incentive, that and the lack of any basis step up for people to earmark these, assets in these accounts for charity. And the other thing I want to mention is relating to philanthropy and our interest as alumni and maybe benefiting the college, is we have the ability for over 70 and a half to gift up to $100,000 a year of an IRA. The IRA and 401ks do not apply. IRAs are the only ones that are eligible for this benefit. But if I take $100,000 out of my IRA and make a qualified charitable distribution from that IRA this year, up to $100,000, it doesn't need to be $100,000. It could be anywhere between $1 and $100,000. Then I can do that. In the old days, before the enactment of this benefit that we now have, this ability, this opportunity that we now have, I would have to receive a distribution from that IRA and then in turn gift it to the charity, and the tax benefit from that is less than if it's directly distributed to the IRA. I could take a deduction, but oftentimes that deduction will be limited, particularly for high bracket taxpayers. And the direct distribution will allow St. A's to receive that, say, $100,000 if I max it out, without that being taxed at all because of St. A's or any other charity's tax exempt status. So those are the two, I think, significant things that I wanted to mention in the retirement area. Still a great deal. Roths are still available. Who knows what their future will be? There will be a lot of low-hanging fruit, I think, if Georgia goes blue and we have Democratic control of Congress and the executive. There'll be a lot of low-hanging fruit for them to try to pick, and Roths have always been on the table as a potential target. So make hay while the sun shines there as well. If you've got conversions, Roth conversions you can complete, then go ahead and consider that. Deal with your financial planner and see if that's an opportunity you want to take advantage of. So that's pretty much it, Peter, in terms of.
Thank you, Joe. Yes, and Jim Flanagan had asked me to thank both of you, obviously, your participation, but specifically about IRA distributions. We are getting more and more every year contributions from college from IRA accounts, and it makes great sense for most people over 70. And we're encouraging that to be considered. Bob, I wanted to ask, we had talked the other day about death taxes. Joe spoke about the $11 or $23 million exemption from federal death taxes, but a number of states have their own systems for death taxes that people need to be aware of as well. Not New Hampshire, but others, and a number of our alumni live in those states. Could you address those?
Absolutely, Peter. State death taxes are in certain states, and it's not every state. Most states don't have a state death tax, but the ones that do, it can be incredibly onerous, and that includes New York and California and some other high tax states. And if you live in those jurisdictions, it is incredibly important that you factor that into your planning. There was something in the paper yesterday that Elon Musk is moving from California to Texas. That's mainly income taxes, but it also has a lot to do with death taxes, particularly in California. If we can get back to Joe's comment on the IRAs, one thing to mention is that the required minimum distribution for 2020 has been eliminated. If you haven't made it already, you do not have to make it this year, but it is necessary to make it next year. That's if you've turned 70 and a half or 72 under the new legislation. So people that are making charitable gifts out of their IRAs should think about deferring making those gifts until 2021, since there's no required minimum distribution in 2020. If they make it in 2021, it will carry out that required minimum distribution and not have to pay any taxes on it.
How about Bob, Massachusetts? A number of our alumni people I work with are in Massachusetts.
They definitely do have an estate tax. I quite frankly don't know exactly the numbers because it's been a while since I've had any clients that are there. But absolutely, Massachusetts is an important state with death taxes that you really have to worry about.
Yeah, I believe I haven't dealt with it often lately, but I believe it's $1 million, beyond
Right.
$1 million. The estate tax can kick in at, might be 10 or 11%. I'm not sure. Joe, maybe you know.
Yeah, it is. It's $1 million is the exemption level. So it kicks in at a pretty low percentage, but tops out at 12%, which could be a significant tax burden. And people think that if they're not Massachusetts residents, they won't be subject to the Massachusetts estate tax. But if I am a New Hampshire resident, for example, or a resident of any other state, and I own a piece of property on the Cape or on the Vineyard or Nantucket, any of these places where there's high-priced real estate, vacation real estate, second homes, then I am potentially subject to Massachusetts estate taxes. And the way the system works is counterintuitive. It's not like if I own a piece of property that has a value less than $1 million, or say $1.5 million, then either if it's less than $1 million, I'm not subject to Massachusetts estate tax. I don't have to worry about it. Or if it's $1.5 million, I only have to worry about the excess over $1 million, $500,000 being taxed at a relatively modest rate. That's not the way it works. You file your Massachusetts estate tax return as if you're a Massachusetts resident with all your potentially estate taxable assets federally. You determine what the Mass tax would be, and then you take the Mass property as a percentage of your total assets. That gives you a percentage, and you multiply that by the tax you would have paid in Massachusetts, and that gives you your Massachusetts estate tax. So you're going to pay a tax, even if the property has a value less than $1 million, if you own a lot of other assets. So it works in a way that people don't understand and don't think about. They assume that they won't be subject to it. And there is a way for people who own vacation properties in Massachusetts to avoid the Mass estate tax, and that's by putting that property into a limited liability company. And the way that works is that constitutionally, Massachusetts only has the ability to tax assets that are within their borders, and real estate is obviously within their borders. So if I own a piece of real estate, Massachusetts clearly has taxing jurisdiction over that. But if I transfer that to an LLC, say me and my wife, we each have a 50% interest in that real estate. We transfer it into an LLC, take back what are called member interests, which are like shares of stock in a corporation. We've transformed our ownership into an indirect ownership of the real estate through these interests that we own in the LLC. And they're classified as something called intangible personal property, which has its taxing situs in the state in which its owner lives. So you've transformed that asset from a taxable asset in Massachusetts into a non-taxable asset. And that's a way that you can avoid Massachusetts estate taxes. You got to make sure that it's not just what's called a single member LLC to take advantage of this strategy. It should be more than one member. Me and my wife was my example. but it's an easy way, a painless way to avoid mass estate taxes. The only state that's closed that loophole, there are 17 states that still have freestanding state estate tax systems. We're the only state, New Hampshire, in New England, that doesn't have a standalone estate tax. But the only place that doesn't, that LLC strategy doesn't work is in Maine. And many people own valuable properties on the Maine coast, the Rockefellers, others. Maine closed that loophole a few years ago by saying, we're going to tax those LLC member interests unless they have a business purpose, unless the LLC has a business purpose, which is almost never the case. And that statute is probably unconstitutional, but I haven't found any client that's willing to test it yet. So if you own property in Maine and you're an out-of-state resident, it's probably, you're going to pay the piper eventually. But in all of the other states, whether you've got property in Newport or Block Island or on the coast of Rhode Island or, Connecticut or Vermont, a lot of valuable properties in Vermont, the LLC strategy is still viable.
That's great advice, Joe. Thank you. A number of our alumni ask about those issues, and I've had a number recently that have established domicile out of Connecticut and into Florida for these tax reasons, this specifically. Bob, we had a great question regarding investment. Mary asks, the economy is doing well, the markets are high, but you see the food lines, you see the unemployment rates. There's obviously a lot of difficulty out there still. There was before, even more now. Are there ways to combine investment planning for yourself with compassion for those that are really suffering? Are there compassionate investments in some way or other that you could talk about?
There are certainly a number of funds that are environmentally sensitive, if a lot of people are attracted to those. Certainly, I mean, if you have appreciated property and you want to give it to a charity, make your deductions through appreciated property, you eliminate the capital gain, assuming it's been held more than a year, it's long term, to help the charity and not pay the capital gains on that. That's the most direct way to help those that are less fortunate by far.
Thank you. We set up earlier this year with the Board of Trustees approval, a compassionate fund right here at Saint Anselm to help students that had financial difficulties or student families with a student relief fund, and that people very generously supported that with their gifts to St. A's this spring and summer.
Absolutely. A number of charities have done the same thing, especially with the COVID issues.
Yeah. I mean, we're more fortunate than most colleges. I think we've done such a great job of planning, and our students have still succeeded in this year.
Absolutely. There's no question. St. A's has been on the top of the list on schools that have done well with COVID.
I'll stick with you, Bob, for a moment. Somebody asked a question about DAF, donor advised funds.
Yes.
Are those still something that people are doing? What are the benefits? What can you do with those? Donor
advised funds are still very popular. You create a fund with an investment firm or a bank, and it's the equivalent for most charitable deductions of a gift to a public charity. The 100% deduction for 2020 does not apply to donor advised funds, and you get a deduction for the assets that you put into the donor advised fund, and then you can use that fund over a period of years. You don't have to make any mandatory distributions out of it, and you basically ask permission of the investment advisor to make gifts to charities. So it's a way of accelerating your deductions into a current year and then deferring them over a period of time to benefit usually public charities, any number of public charities. It's a much easier and less onerous way of creating a type of vehicle like that, as opposed to a private foundation, which has a lot of very stringent rules, and the administration of can be very difficult.
Thank you. Again, like IRAs, we're getting a lot more gifts from donor advised funds each year. They seem to be a great way for people to control the flow of their tax deductions.
Absolutely, and have more control over a period of years. In a year like this, where if you want to make a large charitable deduction and you don't want to give it all to one charity, a donor advised fund can be a very attractive vehicle.
Joe, back to you for a moment. We had a question about Medicaid trusts, especially in Massachusetts. Are those things people are still doing to try to shield assets from nursing homes or long-term care?
Yeah, Peter, we in our office don't do any Medicaid planning. We know enough about it to be somewhat dangerous. I've got a stable of lawyers here in New Hampshire, what they call elder lawyers. And that doesn't mean they're elderly. That means they serve an elderly client base. But they do a lot of that. We had a notorious law firm here in New Hampshire that ran advertisements and conducted seminars about, it was really fear mongering. Don't let your inheritance, be expended on a nursing home stay. And they did a lot of unnatural things, like had people transfer assets to irrevocable trusts, retaining maybe life estates and certain powers over those trusts, sort of a have your cake and eat it too kind of a thing. And that would trigger what's called a look back period in terms of the countability of those assets for determining their Medicaid eligibility. Medicaid eligibility rules, it's a needs-based program. It's a welfare program. And so if it's means-based, they bootstrap off the Social Security disability definition of eligibility, and all assets must be counted, including assets owned by both spouses. The rules are very complex, but suffice it to say, these lawyers that did these sorts of things would have people transfer these assets to trusts, kind of retain whatever interest they could, get as close to the line that separates countability from non-countability once the means testing is applied, and then be able to be in a Medicaid bed with a shared room. I was in that room at St. A's with 3 roommates. It was about a 200 square foot room, but these are like Medicaid beds. People who engaged in this planning were probably disappointed, many of them, that they couldn't get these assets back, and they were relegated to a subsistence level living in a nursing home. And also, Congress and the states that administer these programs have always been fighting a rearguard action against these strategies that are overreaching, and closed a lot of these loopholes over time. So for my money, there's precious little you can do. I always tell people the best solution, if you're concerned about the cost of long-term health care, is while you're relatively young and the underwriting process isn't going to be onerous, buy long-term health care insurance. And that's your best bet in terms of hedging your bets against the confiscatory costs of nursing home care. And generally, women usually who go to nursing homes end up spending more time in nursing homes than men, but most of the studies in this area show that. You all right, Peter? He's on the phone. Most of the studies show that the cost of nursing care are not as quite as draconian as a worst case scenario by some of these fear mongers would have you believe. So yes, there's still a few strategies left. I can't tell you what they are, but if anybody who's in this area cares to pick my brain about who the most responsible elder lawyers who practice in this area are, that aren't going to get you into trouble or give you what's called donor's remorse after the fact, I can provide some names.
Thank you. That's terrific, Joe. Bob, I wondered, we're coming up almost to the end of our hour here. Other thoughts about investments or charitable deductions, that sort of thing that people might want to think of in the next couple of weeks before the year ends?
Yeah, there's one thing that Joe was talking about on the retirement accounts and the elimination of the stretch IRAs. One thing that I've been thinking about for certain taxpayers, that in 2020, if their income is down because of COVID and they're working less or whatever, and they're in a lower bracket, and they have a traditional IRA account, that they might consider transferring that before the end of the year into a Roth IRA. Now that's a taxable event, and they'd have to have enough money on the outside to pay the additional tax of that transfer. But Roth IRAs, I think, have become, while they're still legal, have become more attractive because of the fact that not only do the assets grow tax-free within it, that when you take money out of it after you're age 72, it's not a taxable event. So it's attractive to the donor to get an IRA, and it's much more attractive to his heirs, his children, if it's left to them, because although they have to take it out in 10 years, it won't be a taxable event for them. So for certain taxpayers in this year, it's, as always, they should consult their tax advisor, but it's something that some people might be able to take advantage of for a very advantageous rate if their income is down this year.
That's a good thought. Is there concern, though, that the government, I think you mentioned, will sort of after the fact start attacking Roth IRAs?
I mean, I would think it would be very hard to eliminate them after the fact. They might eliminate the ability to do them in the future, but if they're in the law today, I would be very hard pressed to think they'd eliminate that tax benefit.
And they wouldn't try to impose a tax on the withdrawals after all?
Under that would, I never say never when it comes to tax law, but it would be hard to imagine them doing that at this point.
Yeah. Joe, let me go back to you, Joe. And again, any final thoughts or any things that people really want to concentrate on before the end of the year or right away at the beginning of next year?
Yeah, so those who might be concerned about getting in under the wire this year, making hay while the sun shines, as I said earlier, in terms of the exemption and the paranoia around there that they might be reduced, I say, take a deep breath. Don't worry. You can have plenty of opportunity. I tell my clients, talk to me after January 5th, and we can talk turkey about whether, in my judgment, we've got a very good ear to the tracks. I'm a fellow with the American College of Trust and Estate Council. There's always intelligence coming from what's happening in the tax writing committees, what's in the pipeline, what the effective dates might be if there's any legislation. We are going to definitely have a good portion of next year, no matter what, to still plan to take advantage of the laws as they exist now. So do not lose sleep over what you might perceive as a fading opportunity. We still have time. And if one or both of those Senate races in Georgia go to the Republicans, we've got 2 years before the next congressional elections, and we'll have divided government between now and then. And there's no way that the Senate Finance Committee is going to support legislation that would significantly reduce estate or significantly reduce the benefits that are available in terms of estate and gift tax avoidance. So,
Thank you. Joe, Bob, both of you, thank you very, very much, not only for today's seminar, today's great information. I'm sure a lot of people will benefit from it. Thank you both for your service to St. A's over a number of years. It's deeply appreciated, your support, your counsel, your advice. Joe McDonald and Kanyuk in Concord, New Hampshire. Bob Connor, thank you very much for your participation. To all of our listeners, I wish a happy Hanukkah, which starts tonight, and a very blessed and Merry Christmas and health in the new year. Thank you all very much, and enjoy the rest of the day.
Thank you.
thank you.